I'm fine, thank you very much.
Okay, this is being recorded, you guys. One thing I say at the beginning of all these things is watch this again relatively soon afterwards. I notice a lot of you guys are returning, people that have probably watched a few of my webinars, and I'm sure that you've traded options before, some of you anyway. And if you have, I'm going to be throwing in some nuggets that even you guys can have some takeaways from, and I'm going to be trying to make this basic enough that a brand new or newer option trader will understand. A lot of these things that I'm going to be talking about are ways that we would trade them on the floor, or at least would like to have traded them. We didn't always have the option of what strikes and things of that nature that we traded, but we did learn very quickly which ones we did not want to trade and when we didn't want to trade them. So I'm going to pass some of that on to you, because we have that ability now trading online that we don't always have to pick the strike that's given to us. We can pick any strike we want, and from that, I hope you guys will have a lot of takeaways from this. So, without further ado, let me get a couple of things out of the way first, though. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've traded. I started trading in college with some money I'd earned, and decided to move to Chicago to work on the floor of the Board of Trade. So I started out as a runner and worked my way up into the pits, and been trading ever since. Like I mentioned, I did start trading in college with that money I had earned. I started trading with a psychology degree, and then decided that I liked trading so much that I wanted to switch over to finance. So that's what I did. And in that time, I've traded everything from stocks, financial futures, commodity futures, and currencies on all that stuff there. Let me see. Why isn't this? I've covered up because I moved my thing. I've covered up my changer here. All right. So this disclaimer says any opinions, news, research, and analysis or other information contained here are material provided by ProTrader Strategies and associated companies or employees, is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities. At the end of the day, you guys, we're here to teach you how to swim. We're not here to swim for you. Another thing is, I'm going to be talking about stocks that may very well be in my portfolio, and that's only because we're going to have a directional assumption, and that's what I'm going to kind of be talking about. It may already be in my portfolio. I'm not trying to get you guys to do that. The other thing is I can't give you an investment advice because I don't know your risk parameters. I don't know what's in your portfolio. So take what we teach you and implement it in your own way. All right. So you can also follow me on Twitter at Wolfman's blog, or follow me at ProTrader Strat. Mostly trader wisdom here and deals for some of our different products, but you'll get snark and hopefully some good good information from me on Twitter. Real quick before we move on, let me pull up my glasses here. All right. You should have stayed in psychology. The markets are about psychology and sociology than finance. You know what, Farshid? That's one thing. When I was on the floor, there were guys on the floor that would actually ask me what the economic data points were. Like all they knew is that if like non-farm payrolls was up, that the bonds were going to go up, and stuff like that, or actually the S&Ps would go up. ISM, or what we used to call NAPOM, which was a National Association of, I don't remember what it was called, but now it's called the ISM, Institute for Supply Management. But what those data points would mean, what is PPI? I don't know what that is. What is CPI? I don't care. They were like, if CPI is up, the stock market goes up, kind of thing. And the psychology aspect, you're right, is probably more important in trading than anything else, especially even on the floor. Like you'd be able to tell when people would start getting ticks and what their tells were, if they were too short or too long and stuff like that. So that stuff really came in handy. And now even more so, how to keep your emotions in check, because one of the most difficult things about trading and is to try and stay mechanical and try to not get emotional about money. So if you're, for one thing to keep in mind, if you're really worried about a position, you're probably trading too big. So start out small, and when you start getting comfortable with that, like it's, second nature, then start moving it a little bit higher. So that's one thing I can suggest. The other thing is follow my rules, and if you follow the rules and stick to them, you are more mechanical, and you're going to be able to sleep better at night. So great point, Persia. All right, so like I mentioned, this is going to be on the long put. This is going to give, whenever you're buying an option, the basic rule of thumb here is that it gives the purchaser the right but not the obligation to sell this stock at a certain price. So this is, whenever you're doing a put, you're betting on the downward movement, or you have a bearish assumption. So if you have a bearish assumption, it would be like shorting a stock, and you'll be able to short that stock at the strike price. So the idea is that if the strike that you have bought is where you would short the stock. Does that make sense to everybody? I know there's a lot of people that have been communicating back and forth that have had a lot of option experience, but the idea with a long put is you're bearish. So what you're doing is you're buying the right but not the obligation to sell that stock at the strike price. And that's the beauty in anytime you're buying or writing an option, is that you don't have to necessarily short that stock. You can take advantage of it in the movement. You can go through the assignment stuff, but I would suggest that if you're directionally right on this particular strategy and this put goes into the money, that rather than going out there and shorting the stock would be to cover, or to take this and short the stock, to go through that whole process with all the money that's involved. Just get out of it and reassess with another month or something like that. Go out and do this again somewhere else. But there's a lot of fees and a lot of other margin things that go on involved, or get involved with shorting stock. And I would suggest just not necessarily doing it unless you already own that stock and you can put it to somebody. So this is really going to be under the assumption, you guys, that you don't really own the stock. But if you're buying the long put, in order to have it as like a synthetic stop or something like that, that would be a different situation. But what I would suggest is that if you're just doing this as a long put for a directional market assumption, to not go through that whole assignment process. It's just too costly. All right. So if the stock goes down in value, that's when we are going to make a profit. So that's what we're looking for. A bearish directional assumption with this. Okay. Does that make sense for everybody? All right, so the delta, these are really important Greeks, and I'm going to kind of run over them, try and make them as simple as possible for you guys to understand. And delta affects the option premium in relation to the underlying first dollar move. And that doesn't matter if it's up or down. It basically is the first dollar move. It's going to tell you what that price is, and let's just say we got Activision here. So we're going to be looking at the puts over on this side. So I have it on volume and open interest right now, but let's look at the delta, the gamma, theta, and vega, and that's what we're going to be looking at as we go along real quick. But this delta, what it tells us is this is Activision goes from $66.73 to $65.73. That's the first dollar move. That means that these 65 puts would increase in value by 35 cents. So they would basically go from, let's say 125 and add in that 35 cents. That gives us 160, right? So they would increase on that first dollar move to 160 from that 125 mid-market area. So we add in the delta on that first dollar move. And this negative is just meaning that we're not really subtracting it out of there unless it goes upwards. If it goes up by that dollar to 67.73, then these would decrease in value by that 35 cents, and therefore it would be trading around 90 cents on that first dollar move higher. So that's what delta tells you, and you can see it affects these ones that are further out of the money a little bit less. So delta, one thing it tells us is what that first dollar move means. Now there's like 6 different things that delta tells you, and I'll sprinkle those in throughout my webinars. But one of the main things to understand with delta, especially for the newer trader, is that the first dollar move is how it's affected, and we are directionally to the downside, so that 35 cents would be added into the strike price. The next thing to understand is gamma, and that's what we talked about that. Gamma is the rate of change of delta, and all that means is the second dollar move. Gamma comes into play. So when we're looking at these 65 puts again, that first dollar move, remember I said adds that delta in there. Well, then the second dollar move, the idea is that the gamma will be added into that. So the first dollar move down, this goes to a dollar, what did I say, $1.60. That second move down, the delta will increase by 7. The gap will increase by the gamma, so it will be increasing by 43 or 42 cents on the second dollar. So first dollar gets 35 cents. The second dollar down move would have that gamma added into it. So it's the rate of change in the delta for that second dollar move. Pretty easy. Just remember that. Gamma is the second dollar, delta is the first dollar. So you add that in. So if it moved down 2 cents or $2, that first dollar we're at $1.60, and then the next dollar down would be increasing by 41 cents, so it would be worth $2.02. Does that make sense? So it's that second dollar move, it'd be increased by 42 cents. Okay? All right, and then theta, the next 2 guys are like the thieves in the night that come and steal your premium, and we're going to have to be very conscious of these guys, especially for this particular strategy, because we're buying the puts, and when you're buying something, you really have to worry about the decrease in value, and theta is the thief that comes and steals our premium. It's the impact of time on those premiums. So in that same example, we'll look at the theta, which is right over here. So every day that goes by, this premium is going to decrease by 3 cents, all other things being equal, you guys. So the idea here is if it just stayed here, nothing else happens, volatility didn't change and everything else, this premium would decrease by 3 cents per day. Okay? Does that make sense? Sorry, what are you saying, Eric? Why are the Greeks based on $1 move instead of the real 1 cent move of the equity or trick value? You know, they are in a sense shady. So the deal is, like, if this increases, you know, by let's say 10 cents, let's say that since we're directionally biased to the downside on this, you know, that delta is affecting this premium even on a 10-cent move. You know, it's only going to be 3.5 cents increase in a sense. Does that make sense? So even if it moves down by 10 cents, if this goes from 66.73 to 66 or $66.63, this premium would increase by 3.5 cents because it's a tenth of that. So they do base it on, you know, even when we were talking about Vega, Vega is a measure of change in volatility, and that has to do with the change by 1 percentage point in volatility. But having said that, when we're talking about the volatility now, when this volatility increases by 1%, going from 27.44 to 28.44, then that increase of 1% will affect the premium by 8 cents. So if it increases by 1%, this premium will increase by 8 cents. All other things being equal. That means that the market didn't move, the time hasn't changed, the days haven't changed or any of that. This would increase just by volatility increasing by 8 cents. Now, this is really important for this strategy, the Vega, that we want it to be really low because we don't want this to decrease. If this volatility decreases, then this number, if this decreases by 1%, then you subtract that 8 cents from our premium with nothing else changing. So it's really important when you're buying calls and buying puts that you are getting it at a very low volatility or implied volatility percent in a sense. So let me shut this door real quick. Sorry. Sorry about that. So we want volatility to increase because we want our premiums to increase, right? If we're buying something, we want it to increase in value. We don't want it to decrease in value. So it's really important, and one of the best ways to increase your probabilities of success with this strategy, the long put, is to buy it with really low implied volatility, because if volatility comes out, our premiums decay quicker. We want the volatility to come into this market, and that's the beauty in doing puts. A lot of times when the markets go down, we see volatility expand faster than when the markets go up really hard. We usually see volatility come out of it. Now, that is a general and very broad stroke, you guys. We have seen, especially in the last couple of weeks, when we've had these big moves in equities higher, that we're seeing some volatility spikes going on. And that has to do with we're at all-time highs. And when we get to all-time highs, like we have been for what seems to be the last year every single day, that people start buying puts to protect their gains. Now, I don't like buying puts to protect my gains on a stock. I think that really is a Sisyphean type scenario. You're really looking for a black swan event in a sense. But what happens when you buy puts against your stock is you synthetically increase what you paid for that stock. So keep that in mind. If you're constantly out there buying puts to protect your gains, you're actually eating away at your yield, because if that put decays worthless, then you spent money on that stock and you've basically made yourself pay more for that stock. So I don't really like the buying put strategy to protect your gains with a stock. This is basically, we are very bearish in something, and if we're very bearish in the underlying and we are holding that stock, I would suggest getting out of it. If you're bearish in a stock you own, just get out of that. Don't even worry about it anymore. But buying puts is not a strategy I like to add to a stock that I own, because you're increasing what you paid for it. All right, so volatility we want to increase in here. We don't want it to decrease. So if you're buying something with really high implied volatility, and this is a chart of volatility for Activision, and if this volatility slams down on us here, as you can see, when the market was falling, we started getting that increase in volatility. That's what I'm talking about. That's what we would want, is that directional move down and that volatility increase. Then you get double, you get paid double. You get directionality right, you get volatility to expand. That's a beautiful thing, especially when it happens quickly. But you can see as the market goes up, a lot of times volatility comes out of these products. So you can see that volatility started coming out. And then this is what I'm talking about. We're starting to see it go up, even though the market's going up. So you will see that, and that's has to do with people protecting gains and things of that nature. But I want the big takeaway with the long puts and even the long calls is you want volatility increase. So you need really low implied volatility percent for these particular products we're going to be trading. All right. I see a couple questions coming up real quick. Let me answer those real quick. The strike prices are in dollar or in half-dollar increments, so the Greek pegs those increments. Yes, the Greek is telling you for that particular, in this case, half increments, what it will be for the next. It's still a dollar move, still based on a dollar here. So, but it's just telling you what that increase is going to be off of that move from that strike. Okay. All right. Let's see a couple other ones. Can you please show the slide again on all four Greeks explained? Yes, I will while I'm answering another real quick question right there. When a stock is moving higher, wouldn't the volatility of the long puts drop? No, the volatility isn't necessarily going to drop on just the puts. You're going to see that being affected on both sides for the most part. Because when the volatility expands, it's going to affect the premiums on both sides. Yeah. Okay. All right, so let's go over the long puts really quick. We have to be very bearish, and if you guys saw the one on the long calls I was talking about, you know, you got to be more bullish than a matador. I don't have a real good thing for the long puts, but you want to see this thing tank quickly, because remember, we're buying these. We have to worry about the impact of theta, and we want this to happen rather quickly so that we don't have that theta come out of our underlying. So, all right, we want to make sure that happens. And you guys, delta also increases the closer you get to expiration. So keep that in mind as well. So for the ones that are at the money options, all right. And delta is not consistent, all right. It's a concept related to gamma and other things that get a little bit more complex, but it's another risk measurement also. So, which is a measure of the rate of change of delta given the move in the underlying. That's for gamma, just to be clear. I see somebody, Jack had a question about that. And delta will change given changes in volatility. So as this volatility increases, our deltas will substantially will increase as well. So as we're seeing something like this happen, where this volatility starts going up right here, it's going to affect this volatility here, and these deltas will increase. And the reason why, one way to think about it is delta is also a determining factor of probabilities. And I know some of you guys are returning, and you guys know that I trade and talk about every trade I do has to do with probabilities of success. And you know, the long put, the long call are low probabilities of success type strategies. The way to increase that is the right environment. But for instance, delta tells us not only how much this is going to change, but delta tells us what the probability of the underlying trading 1 penny or trading to where this strike is 1 penny in the money at expiration would be the best way to explain that for both the calls and the puts. So in this case, delta tells us that there is a 35% probability as of right now that the underlying will trade down to $64.99 by and expire 1 penny in the money in 35 days. So that means on that final Friday, like today was an expiration Friday, right? So 35 days from now, that this underlying will be trading at $64.99, causing this strike to be in the money by 1 penny. And that's the same thing on the call side. This delta is telling us that the calls will have a 45% probability of being 1 penny in the money, that these strike this 67.5 strike. So in 35 days, there's a 45% probability that the underlying will be trading at $67.51. So one penny in the money. Okay. Delta also, this is a floor trader hack, tells us that our floor trader hack is that 2 times the delta is the probability that the market will come down and hit this 65 even number in the next 35 days. So there's 2 times the probability of it kissing it or touching it than there is the probability of it finishing there. Okay, so 2 times greater probability. That's why, if you guys notice, I don't ever take anything into expiration. I take the probabilities. When the probabilities are in my favor, that's when I'm getting out of it. So that's what I'm looking for in this particular strategy, is to increase my probabilities of success by doing this in a low implied volatility percent market. And when I get touched on my strike or just see it go slightly in the money, that's when I'm usually going to be looking to cover this strategy, because I've beaten the probabilities. Okay, so we're very bearish. We want this to happen right away. Also, essential to success is being aware of dividends. Now, this isn't as important as it is with calls, and yes, they do price in the dividends a lot of times, because what happens with dividends is when the dividend comes out, when they come out with the dividend, what happens is the stock will decrease by that dividend value. So if the stock goes down, it affects the calls. But traders are pretty savvy. They're pricing this move into the market, even if it's not necessarily declared yet. They've got a pretty good idea of what their dividend is going to be going forward. So we just have to be aware of the ex-dividend date, which is this is the day that the shares bought or sold are no longer offered a dividend. So if they're not offered the dividend, that stock price decreases in value equal to what that dividend is going to be. All right. So you got to own that stock before the ex-dividend date to receive it. And as soon as it's after that ex-dividend date, then those holders of those shares won't receive that dividend. So the stock decreases by that value. It's kind of like when if it was a 25-cent dividend, that stock will decrease by 25 cents. Now, that's not written in stone, because the market is being traded, you guys, and it doesn't always necessarily decrease by that amount. Sometimes the next day it'll come out and it'll be 50 cents higher. All right, it's a rule of thumb that that's what is supposed to happen. It doesn't always do that. All right, so keep that in mind as well. You take profits on the POT alert occurrence. What is the POT alert? I'm not sure if we're talking about the same thing. All right. And keep in mind, that it's going to be pretty closely priced in. All right. Picking the right underlying, you guys. The importance of picking the right underlying here is making sure that when you're trading options, that you are trading options that have a lot of volume and open interest. Make sure that the bid ask is tight. That being said, a stock under $100, we need the bid ask to be something that is, inside of 10 cents. And of course, Activision usually is inside of 10 cents. Right here, you can see 10 cents on the 35 days to expiration. The monthlies that are closest to expiration, you want to make sure that those bid asks are inside of 10 cents. You could look at the POT, Shady. You kind of threw me for a loop here, because I was thinking about using this as an example. So with potash, you can see a lot. Potash, when it was trading up in the 30s and 40s, it actually had a lot better markets. But you can see potash is under $100 stock, but the bid ask is pretty wide here. So something like that, we want to stay away from. The other thing is Aon. Everybody's heard of Aon. I always use this example as well. Aon's $130 stock. That's over $100. So any stock over $100, we move the decimal 3 ticks to the left, and that's how wide it should be. So, round it up 14 cents. And as you can see, they are, closer to 25, 50 cents wide. So we want to stay away from a stock like Aon because you have to give up so much edge to get in and get out. And especially if we're directionally right with this particular strategy, you can see that when it goes in the money, they even get wider. So it's even more difficult to get out of these. And we're hoping that this goes into the money. So we need a lot of volume and open interest. And as you can see, the volume traded here on these contracts, not very many, 22, 24, and very little, almost no three or 4-digit open interest, which means there's not a lot of participation in there. If we looked at something equivalent, relatively equivalent, is Apple. And look at all this volume and open interest that's going on. I mean, look how much volume traded in here today alone. And rule of thumb would be move it 3 ticks to the left, 17 cents wide is what I would expect. Well, look at this. They're a nickel wide. That's because everybody and their brother is in here trading Apple on a daily basis. And that means that there's a lot of volume and open interest going on in the ones that are in the money. So you're going to have a lot easier time getting in and out. If it's $1 wide or $3 wide on some of those stocks that nobody's trading, then you've got to give up basically all of your profits to get out. So you're taking a lot of risk and you're not going to get rewarded for it because you have to give up so much edge to the one trader that's in there making markets. Right. Okay. So you take profit at the probability of touch occurring. Yes. Shady. I do. POT, probability of touch. Yes. The stock, Larry, the stock decreases by the dividend amount plus or minus the market moves. Right. Yes. The market really ultimately, we could, I think even Apple does this a lot where they'll come out with an earning or a dividend. And look at this. So the 63-cent dividend, this is the ex-dividend date. So you would expect the stock to go down by that much. Well, you can see it went up. Here it went down by more. So, it's not always going to be that exact amount. Here it goes up. So the ex-dividend, 63 cents, it looks like it didn't decrease by at least the 63 cents. So, but the idea is that's going to be priced in to the premiums on that expected move. So, since Apple's always given a 63-cent dividend, everybody's probably expecting the next dividend, or at least very close to that, 60 some odd cents, even if it's not declared yet. And we're going to be out there sometimes with the long puts where it is in an area where they may not have declared what their dividends are yet. So keep that in mind because I want longer duration. So I'm kind of getting chatty early, but let me get a couple other things. Picking the right strike, increasing our probabilities of success. If I am, kind of bearish or pretty bearish on this, I'm going to be picking somewhere between the 45 and 35 delta. On the lower priced stocks, I'm going to probably be picking the 35 delta just because it's not going to usually give you a 45 delta one. But somewhere between the 45 and 35 delta, I usually like to go with the 35 delta because I get a nice increase in my premium on that one because it's usually about $1 or $2 away. Okay. And then picking the right duration. This is what I was talking about theta. Remember how I was talking about how theta is going to decrease the value of the premium. So this is the option price in a sense, and this shows you what happens when the days go on and the premium comes out of those strikes. So as you can see, it's relatively flat. It's always going to be decreasing, but you know, the closer we get to expiration, the more that theta starts increasing, and that thief really starts. The longer that thief's in your house, the more he can steal, right? So we want to stay away from this. We want to capture this slow decrease up here. So further out on the option chain is where we would like to go. You know, I usually like to say around this area, like the 70s, somewhere around in there. But right now, we're going to maybe even have to go out to the 91s in some of these. So, you know, that's okay too. The other thing is because this is a low probability strategy, you guys, we want to get out here further to allow ourselves enough time to be right. So stay out here. It doesn't mean you have to hold it that long. It just means you get yourself the opportunity to be right for a longer duration. All right, picking the right environment. I talked about this. We want low volatility. Every single stock, you guys, has its own volatility. Tesla is probably more volatile than, let's say, you know, a utility or something like that. So we're not necessarily looking at what volatility is, but where the volatility is in relation to where it has been on itself. So for instance, you know, Apple has a 16 volatility right now. That's where volatility is for Apple. But we can look at like something like Tesla, and this is probably close to a 50 IV percent, I'm guessing, just by 30 IV percent. So what we're looking for is a low IV percent, so something below 30. Apple's pretty close to that. The reason why is, as you can see, when it's really low, it has a tendency to come back. So we're looking for something that is really low. And this is probably, you know, historically where low volatility is for Apple. So, you know, this could be an outlier that could be taken out of the statistics in a sense, and that would really make this really pretty low. So what we do is, for the math, to figure out what implied volatility percent is, which is what this math has been doing, is we take where the current implied volatility is. We have a division table here, a numerator and a denominator. Numerator's on top. We take where the current implied volatility is, subtract that by the low volatility, and then we divide that sum by the sum of the high volatility minus the low volatility. And that would come up with 30.43. The math is there for me, so it's pretty easy. Now, something that we look at like down here, Devon Energy, you can see it's 0 implied volatility percent. Well, that's because it's at the low it's been over the last 52 weeks. Doesn't mean that it can't continue to go lower. It doesn't mean that it can't continue to stay 0 and keep going down. That's one of the flaws with this, but you know, it's the best we can do right now. Same thing as if it's at 100%, you know, and it's at the, you know, 100% could be here, and that's still 100%, that's still 100%, and still 100%, right? But then once it starts coming back, then it wouldn't be. But that you have to keep in mind. Just because it's 100% doesn't mean it's not going to continue to go higher. But the idea is the probabilities of when it's that high that it is going to come off, all right? It's going to settle down and then start moving the other way. So we want something with really low implied volatility percent to start with, because the probabilities are, if it's low, it's going to go back up to basically where the the median is, okay? So we're going to be looking for it to come back to the median in a sense. Does that make sense for you? Your sound is disappearing from time to time. Is anybody else getting that problem? I know my voice is getting scratchy. Yeah, so we are really close to capacity, but If you guys ever have issues where the screen is having problems or the sound's going in and out, log out and log back in, and it should fix itself. And it could be going in and out because I'm rocking back and forth in my chair, which is a bad habit. But anyway, so that's the idea, is if it's really low, it's probably going to go back up. So that's what we're looking for. Okay. And the next thing is knowing our exit strategy with this one. I talked about this. One of the things that I like to do is the probability of touch and getting out there. So that increase. The other thing would be is if you're a technical trader and you like to trade with technical analysis, maybe it's the Fibonacci's, or I use, if you look at my charts a lot, I use the market profile. So I find those different areas there that I'm looking for it to go to. And sometimes I'll even pick my strikes right there. So I look at the probabilities, if it's like, a 25 delta or somewhere between a 25 and 35 delta strike, that's where I'm going to pick it, because I think it's going to go down there and touch that area. So I'm looking for that to happen. All right. And that might, I might forego my probability of touch trade because I'm looking for it to hit a certain mark, and you can do that too, picking that like 35 delta, but yeah, I expect it to go about $1 below that. Write that down. The important takeaway is here, knowing your exit strategy before entering the trade. Whatever that is, sometimes I will say, I'm buying this 35 delta strike, but I think it's going to go a little bit lower than that. I'm going to have an example that I'll show you here in a little bit that I believe is going to, is picking that mark, write it down. I have like five spiral notebooks right next to me that I write down every single trade I put on, why I put on it or put that trade on, what my thinking was, why did I have this directional assumption, what was going on to make me think that it was going to go down, stuff like that. I write all that stuff down on a piece of paper, and then I write down what my exit strategy is. Is it going to be the probability of touch? Is it going to be the Fibonacci level? What is that Fibonacci level in that price? So when it goes down there, it hits it, I'm out. Stay with that. If you write it down, you are more likely to stick to that rule than if you are just having that rule in your head. Okay, well, I'm going to get out when it goes down here. Well, you know what's going to happen? It gets down there, and it's going to happen in like 2 or 3 days, and you're going to be like, well, it happened so fast that now I'm going to squeeze it out because now I think it's going to go to here. No, it probably isn't, and the probabilities told you it wasn't going to, and when it reverses on you, it's going to be painful. You're going to be turning a winner into a loser in a sense. So make sure you stick to that and get out wherever you said you were going to get out. And there's no problem getting out earlier than you said you were going to get out. Just don't watch that become a winner, and more times than not, it's going to go against you and you're going to end up losing money on it. I can assure you. Plan your trade, trade your plan. Beautiful. I love it. I might steal that. Plan your trade, trade your plan. I love it. All right, max profit. One thing with this, it's set, well, it's unlimited. Well, a stock can't go below zero, so it's really not unlimited, but your max profit is this stock going to zero. What's that probability? Slim and none, and Slim just left town. So you're not going to probably in your whole lifetime get a stock to go from where it's currently trading, buy puts on it and see it go to zero. All right. That's not going to happen. So plan your trade and trade your plan. All right. So max loss is the net premium paid. That's beauty in doing a long put or any type of long option strategy, is what your max loss is right away. It's whatever I paid for it. It can't go any worse than that. All right. You can lose all of it, but that's all you can lose. All right. Your break even is going to be the long option strike, and that should be minus the premium paid. So it needs to go, if we were looking at that one example here, if we're looking at Devon Energy, and it goes from, let's look at, yeah, Devon Energy is pretty close to fitting that my rule of thumb of bid ask being 10 cents wide. So for instance, let's look at Devon Energy, and we're going to be picking the 35 Delta strike, right? So let's look at Delta. So we don't have that 35 strike. I would, probably lean towards this one of these two, depending on how bearish if I'm more bearish, I'd lean towards the one slightly further out. This is a 50%, a 54% probability of being touched. So that's probably the one I'm going to look at. That's better than a 50% chance, right? So if I can get it better than a 50% chance, that's when I'm going to do it. I won't usually do this when it's less than a 50% chance because, I'd rather find somebody to flip a coin with and bet dollars or something. So it's slightly better than that. So I'd probably go with this one. But what I'm saying here is our break even would be when the underlying is trading at expiration. All these things are for expiration too, you guys. So the break even is the long option minus that what is it, 60 or 55 cents, let's just say. So when the underlying is trading at 35.45, that's where my break even is at expiration. I need it to go that far at least, so I make up for that. Does that make sense? So it goes down below that. That's at expiration, 35 days, last day of the trading. It's not before that. So like when I was talking about it just coming down and touching that strike, I cover it. Well, and you're thinking, oh, Wolfman said that the break even is, 45 cents below that. So why would you get out there? You're not even at break even. Well, if it happens, right away or in the next few days, and we're not going to be looking at 35 days, but if it happens, in that time, within, say 5-10 days or something like that, not 35 days, then I will be profitable because that theta hasn't come out of it. But we're going to be looking at it a little further out than that 35 days. But just to make sure you guys understand, that rule or that, profit loss long is minus. So that should be a minus. But anyway, let me get that off so it doesn't confuse everybody. That is at expiration. So without further ado, let's get on. So this is where I usually let you guys throw it out there. We'll go over a couple of the stocks that you guys like to trade, and we'll go through those to see if they fit my rules. So not everybody's going to have one that'll fit the rule, but we want something with really low implied volatility percent. And the easiest way to do is throw that up in your watch list. And, you just look at it this way. You wouldn't want to start out up here and start going down, because the idea here is like something with Target, which if we look at the chart on Target, it's got high implied volatility, right? There's no binary event going on. It's just getting, it's just back and forth quite a bit. So volatility is increased on this. And this is one of those times where you see volatility increase in a rally. It's one of the few times you'll see that. But it's happening with Target because of all the stuff with Amazon and Whole Foods and stuff. It's experiencing higher than normal implied volatility for the most part. But having said that, even if this market goes, starts to dwindle down towards our directional assumption, maybe we think it's going to come back down to the point of control or something like that. It's gotten to the value area high. It looks like it's kind of meeting resistance. We could throw Fibonacci up there and see what that looks like and do all of those things. I'm doing it real sloppy. Maybe we think it's hit that Fibonacci level and now it's going to roll over and come back down to the 76 here. Well, if that's your move, for one, I would say write that down, and two, you better hope that volatility doesn't come out of this rather quickly, because if it does and this starts coming off, or even if it's just a slow down move, right, you could see volatility come out of this and it is going to hurt, because that volatility come out will probably be more painful than theta decay even. All right, so let's look at Ulta. Ulta general, or nice. Ulta does usually have good markets in here. It is a higher price stock. You're right. It's kind of in a downtrend. Looks like it may have come up, meet resistance, and we're bearish in it. Just had earnings, so we don't really have to worry about an earnings trade. One thing with, putting this trade on during an earnings. So like if we're putting it on out here, in the January contract or something like that, or the February contract, or even the, March contract, the March contract's probably going to have earnings in it. We don't really care. One thing, if you're doing this and you're buying the underlying or buying this option expiration that has the earnings in it, cover it before the earnings happens. Because as you can see, with especially like Ulta, that earnings happened, you come into that earnings and we own those, the volatility kept increasing, which means the premiums kept increasing, and then you held it one day after the, and boom, volatility just imploded. Okay, and sometimes this move, even though you were directionally right, might not have made up for the loss of premium you felt in that volatility crush. So that's the thing with volatility crush, is especially with this, is if you experience that volatility coming out, that you may be directionally right and not be able to make up for that in the directional move, right? So get out of it unless you're basically looking at it as a full loser. Maybe you were $10 out of the money at the time and you're looking at a full loser, it's trading for a couple of pennies, and you're like, why take it off at that point, right? For 5-10 cents, you already lost probably 3/4 of the premium. I would just be like, you know what, it's a free trade at this point, right? So that would be the only time I would leave it on, as if it wasn't a winner and it was almost a full loser. If it is in the money, I am definitely doing everything I can to get out of this trade before that earnings event, because I don't want to feel that volatility crush. So Ulta, it's a $218 stock. So what's my rule? Move it 3 ticks to the left, and it should be about 22 cents wide. And Ulta is trading around $1. So if you ever see it where it's trading around $1 wide, that's a little, oh, that's 91 days. We want to go to the closer ones, 22 cents. Ulta does usually have pretty good markets in here, and usually has pretty good volume and open interest. So you can see there's pretty good volume going on. Not great open interest for Ulta as of lately, but there's open interest throughout. So if this were during the day trading session and it was like 50 cents wide, I'd probably skip out on Ulta for this one, because that's the other thing. If these markets aren't tight, then these markets out here are going to be even worse. And as you can see, $1 to get in and out. So the reason why I don't like doing that is because, for instance, if I was going to be doing these 36 deltas, or the ones that are closest to it, 37 or 32, somewhere in here, kind of a pick 'em, and at 70 cents wide, if I'm going to buy these, I'm probably going to have to pay upwards of $10.50 or something like that to get into this trade. So if I have to give up that much edge, 30 cents to get in, and 5-6 days goes by and I get my directional move, if I had to give up 36 cents, I almost need $1 move to make up that difference, right? I almost have to have $1 move to the downside just to get where I can scratch it, which is a lot of risk. So keep that in mind as well. So that's one of the reasons why Ulta has fallen out of favor lately, I know, and hence the wide markets. I agree. I mean, I've traded Ulta a lot, and actually they have really good markets in and around their earnings. So that's usually why I am in there trading that. If the stock falls too much, do you have to worry about it being acquired? If you're talking about like a stock takeover, where somebody comes in and buys them, sure, I think that's always in the back of everybody's mind, is that there might be a takeover or something like that. But you won't have to worry about anytime you're buying it. Remember, that's what I was saying. You have the right, but not the obligation, which means you are the one that's in the driver's seat as to whether or not you want to short this stock. So that means basically taking somebody else's stock away from them at that price. Okay, so you would get short, where the calls, if you told somebody, hey, I want your stock, you're basically getting long at that strike. This you would be getting short at that strike, but you are in the driver's seat. And the only time that is going to happen to you is if you pull the trigger and say, I want that, or you ride this in to, say, for instance, you had long puts on in the December contract up here, then they're going to match you up with somebody else. So that's the thing you have to worry about when you go into the money, is if you want to cover this before the close on the last day. If you're in the money. If you're out of the money, then it's worthless. It's zero. Okay. All right. So GLD. This was, somebody called out one of them, so I'll speed this up a little bit. This is one that I was vetting earlier on today. I'm actually pretty bearish. GLD, we've gotten a little bounce. It's gone back to the point of control, which makes me a little nervous about this one. But I'm bearish gold in general. I think the market's doing rather well. I think that is going to get people to come out of gold. We're also seeing Bitcoin futures and stuff like that. I have no opinion on Bitcoin that I'll express here. Follow me on Twitter. I have all kinds of them. But I just really don't know where Bitcoin's going to go. I think that if regulators step in somewhere, that could be devastating to Bitcoin. I think that there's a lot of nefarious things going on in Bitcoin right now, and that's causing the market to go really high. So I don't want to be involved in that at all. But in the meantime, people are pulling their money out of trading gold and putting their money into Bitcoin because, the kind of increases it has. Why would you do gold? So I'm bearish gold for that reason. And I've also, if you've been watching my daily market commentaries, I have it as a target of wanting to go down here to this fib level, which correlated on the futures is 1221. So I think that gold futures are going to go to 1221, which would cause GLD to come down to around this level as well, because they're correlated. So that's what I'm looking for in this. So I would be looking for any strike, above 115 for GLD. GLD is a $120 stock. I know it's an ETF, but $120 underlying. So my rule is move it 3 ticks to the left. We got around 12. The bid offer in these markets should be 12 cents wide. And as you can see, something with GLD, they are tighter than 12 cents wide. They're 2 and 3 cents wide. So I'm not going to have to give out much of an edge to get into this trade, right? Because that's the beauty in having everybody there's so many people in here trading that if I give up 1 penny on these 118 puts, if I bid 72 cents, there's somebody up here watching and like, I'm not waiting for the 73s, it's a penny, and they just give up that 1 penny to get in or out of it, right? I probably could even just sit on the 71 and get hit. Any type of move is probably going to get me hit on that 71 cent bid. Thing to keep in mind is, do you want the penny or do you want the trade, right? You have to make that decision. But not a whole lot of edge to get in and get out. And if nothing happens, I can probably scratch relatively easily if I change my directional assumption. But as you will see, a lot of times those tight markets will correlate to the volume and open interest. And as you can see, tons of open interest, not a whole lot of volume, way out of the money, as there's no value in those anyway. But as you can see, the ones that are closer to at the money, there's all kinds of volume in here. So volume over here being that's what traded today in this underlying, and this is the open interest. That's how many outstanding contracts are on these options. So that's really tight. So then we go out here even further, and you can see, 100 days out, these markets are still 3 cents wide and still have pretty decent open interest and pretty decent volume. I mean, this is good volume for even a lot of options and well-traded stocks near to the expiration. So that's good, right? So I would probably pick the ones that were about those 36 delta. So it'd be a pick 'em between the 18 and the 17. So I don't know. I'm pretty bearish. So I was saying that strike level that I think it's going to is 115. So I would be buying these. And in this case, keep in mind, I'm probably going to forego that, probability of touch rule where it's, comes down and just touches my 117. I'm probably going to be a little more patient and write down 115 if it trades with a 115 handle, so maybe 116, somewhere right around there. 115, 116 is where I'm looking to get out, so I'd keep an eye on that. All right. So in that case, I'm writing it down, knowing my exit strategy. Writing it down. I'm writing down. It gets to the fib level of this 61 fib level here at 115.25. So basically I'd be saying, it trades, and I'd give up a little bit of edge there. I'd say maybe, 115.50. If it trades 115.50, I'm out. Okay. Why not turn into a debit spread lower cost? Well, yes, but because it's a low probability, like selling that option, you're not going to get a whole lot of money for it. So, and because it's a low probability trade, if I sell that option to help finance a little bit of it, I have a rule for the like a long put spread that I'm going to be doing either probably not next weekend, next Friday, but Friday after that. I'm going to be showing my rules on a debit spread, and they're a little bit different. So I don't pick buying an out of the money put in that regard. I'm trying to buy the put for its intrinsic value in a sense, and I'll show how to set that all up and what the strikes are for that. But when I'm doing a debit spread, I have different rules than just doing this naked. This is, we are really bearish on this, and I think that gold's going to tank. So, picking these probably 117 strikes, and when it gets down to 115, I'm out. And I know it's a low probability strategy, so I'm going to be doing this very, very small. Okay, when I'm buying any type of option strategy, I'm doing it pretty small, and this is one of the ones that I know is not a good probability of success, and therefore I'm going to be doing this probably as one of my smallest tranches, if you will. And that's what we used to call on the floor. What your go-to is a tranche. Okay, so when I was trading Fed Fund futures, my tranche was a 50 lot. So if my tranche is a 50 lot, or maybe a 10 lot in options, then here I'm probably buying a 3 or a third the size, so probably a 3 or 4 lot. Does that make sense? Did I answer your question, Dana? We're going to be doing the debit spreads here in a little bit for the puts. And that's about it for it, you guys. I mean, just make sure you stay mechanical with this. And the other thing is on the upside, I usually, when I'm doing these debit calls and puts, I'm usually leaving those on. I have a higher risk tolerance than most people. So in that, if you thought it was going to go down to like 115 and you're using these fib levels and it doesn't go up, or if it goes up and above this fib level here, that might be your stop out. And if you are worried about that, or this fib level could be your stop out, at that point it's probably going to be relatively worthless anyway. But if it goes above this, you would say, hey, if it goes above this, I'm out. But I think it's going to go down here, so if it goes down to this price, I'm out. And use that as your outs as well on a loss or a winner, and make sure you stick with that. I usually let the long puts and long calls expire worthless if it's gone against me. And the other thing is I don't use this as much as I used to, but for this particular one here, because of different ways that I trade with the market profile, right? So I talk about the volume nodes here. This is where the volume nodes are. A lot of times when stocks or ETFs for that matter get to these levels where these lines are, it gets really comfortable. And that's because that's where the most transactions have had. So, when the stock is trading at the price you bought it, right, you almost feel no anxiety because it's right there. It's right where you bought it. If it goes up, a lot, you start getting a little anxious because you're kind of like, okay, well, should I be taking profits? And when it goes against you, you're thinking, oh my God, do I need to get out of this? But when it's trading right at your price, it's, pretty comfortable. And the same thing goes for the short side. So when the most volume's traded right here, it's like everybody's happy. You're not making money, you're not losing money. There's nothing to worry about. I'm even. So the markets have a tendency to, when they get overextended, come back to these areas. So for GLD, because it's come back to this area, I thought I was getting pretty good with this when I was talking about this in the daily market commentaries, that it was going down to 2112, which is correlating to this 115.25 area. And now we've kind of bounced back up to this point of control. So on Monday, if I put this trade on, I might even set a deadline that I need to have this, break out of this area in like 5 days. If it just gets kind of complacent here and starts bouncing back and forth right here for 5 days, I might have a time stop where I'm just like, okay, it's not working. 5 days, I'm out. And I would write that down too. Because 5 days goes by and I don't write it down, I can easily go, well, I'll wait 2 more days or 3 more days. And all right, well, now it's 8 days and I'm already invested in this. Now I'll just wait till the end of the week or something like that. Don't do that. Write it down so you stay mechanical. If you stay mechanical, you'll sleep better at night. Don't constantly second guess yourself. Stick to the rules, stick to what you've written down, and trade it. Okay? Anybody else have any other questions real quick? All right, so here's the offer, you guys, for all you guys that have participated in this. What's a realistic time stop? Edward, on something like that, where it came to that point of control, I would say 5 days, because if it starts staying in that too long, it's going to, it's like a rubber band. The longer it gets there, it just gets a little tighter. And I don't want to be there at the very beginning of the rubber band being wound. I want to be there at the end of the rubber band being wound if it's there, right? I'd rather be getting into that trade 5-10 days after it got stuck on that point of control, because then it's going to want to break out. But right now, because I'm looking at that trade to put on and it just came up there and touched it, I think a 5-day, I would hold that for the week. And if it's not there, then I'm going to just pull the ripcord on it, if that's what I've decided I want to do before I get into the trade, right? Anyway, like I mentioned, I talked about probabilities a lot. And I mean, you guys, wouldn't you agree that trading to increase your probabilities of success is what is going to create success? I mean, that's what created Vegas, was high probabilities. Those guys that built those casinos know the probabilities are in their favor and they are successful. So you need to start trading with that kind of mentality where you have to roll the probabilities in your favor. And you guys need to be trading with this knowledge here, especially protecting your portfolio against rising interest rates. We just saw the FOMC raise interest rates again. They are going to continue to increase interest rates, especially when we're seeing these good economic numbers, you guys. And that is going to decimate a portfolio of interest rates. And when I say a portfolio of interest rates, I mean even if it's 50% or 40% of your portfolio, everybody's got that in like their IRA and their 401k. And if you have a margin account, you may not have the bonds in there, but you still need to make sure you're protecting those other portfolios as well, because it's all your money, right? So I teach you how to protect against those rising interest rates, because you can't chase yield and these guys, if you have a bond ETF or something like that, those guys that are trading that ETF are chasing yield, and they're going to get beaten up in this rising interest rate market. I actually threw that out to a guy one time that was pitching his bond ETF, and I said to him, I go, we are at, historically, it was when interest rates were at 0.25. I said, we are at 0.25. Interest rates are going to increase. How do you counteract the increasing interest rates and the value of those bonds going down? How do you beat that? And the guy just didn't even answer my question, just went on to the next person. Because he couldn't answer that and get people to invest in his bond portfolio or his ETF. So you guys, if you've enjoyed anything, if you've taken anything away, even if you're a savvy trader, one little nugget, you're going to be able to take something away from these videos as well. You know, there's over 10 videos for $36. You know, that's going to be like 10 plus hours, 10, 12 hours of information that you can take away. Plus there's some fun little things in here as well, like the history of options and stuff like that. So basically what it comes down to, even if you're trading with technical analysis, you guys know with the day and age of algos and stuff, they know your pain point. They know where stops are. And that's the beauty in trading options, is they can't find where you are necessarily. They aren't looking for you. They're looking for the other stuff in the other markets. So trading options is the best way to increase your probabilities of success, even if you are adding it in with like technical analysis. So if you're trading technical and building strategies, that's the way to get ahead in this game. All right. So take advantage of this. I teach that. I teach how to play the probabilities. I even teach a little bit about the technical analysis and stuff like that, where I see those levels. And when the probabilities have gone against us, how to stay mechanical to increase our probabilities even further in our favor. Okay. That is huge, is when the probabilities are going against you, how do you make sure the probabilities, you turn that table back into your favor? All right. So we're offering this trial today for you guys. I suggest you take advantage of it. Sorry. Yes, I forgot that. Good call, John. I forgot to add that to the entire list. It's out there in the chat window. I mean, you could pause if you're watching this on the replay Saturday morning or something. You can pause this and punch that into the URL. It's not a live link, but you can punch that into your URL. But that is now in the chat window. So there's a live link that you can click on that. So are these CDs or do you send them to us? Tim, what happens is basically you log in and there is a list of them, and when you watch it, you can click that. There's a little check window that you can click that you've watched it. So sorry, I actually clicked. But you click on the window, so there'll be instead of this little dot here, there's a box, and you watch the video, and then you can click on that box and check it off. So it's real easy. You can watch it from anywhere. You don't have to have a CD player. That makes sense? Thanks, HH. Appreciate the kind words. So it's real easy. And yeah, you can click on that link in the chat window there. Take advantage of this, guys. All right. That's all I've got for you guys today. I want to do one other thing and thank you guys. Again, here's the link if you're watching this on replay Saturday morning. Like I suggest, because I know a lot of you guys had questions and things will fly by. That'll help it stick into your long-term memory. But in later webinars, I'm going to be drilling down on option components and when and where I find trades and when I think they're appropriate, at least for me. You have to decide whether or not they're appropriate for you. And then there's that link, like I said, and thanks for watching. You can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, you guys, there's the all the different ones again, and like I said, it is in the chat window. So sometimes you don't get the link for the recording, Larry. If you don't get the link, email us, trading@protraderstrategies.com. You should get the link for it. There was one on the calls. I had a snafu for a while there where I actually didn't realize GoToWebinar was starting the recording as soon as I started the webinar automatically. Usually I have to click on it. So I actually recorded all of us talking before the webinar started. And then when the webinar started, I turned it off. So, and then did the whole entire webinar without recording. So I messed that up. So I had to do it again. And hopefully everybody got that link. But if you don't ever get it, reach out to us for sure. All right. That's all I got, you guys. If you can't take that, take it easy. Have a great weekend. Thanks, Jerry. Appreciate it. Take care.